Hi, I'm John Darrer, and today I'd like to talk to you about structured settlement commutation riders. Specifically, what is a commutation rider and why would you want one included with your structured settlement? A structured settlement commutation rider is an optional provision in a structured settlement that provides for conversion of some or all of the future structured settlement payments to a lump sum timed to a specific event in accordance with the formula specified in the settlement agreement, qualified assignment, and the structured settlement annuity contract. The most common use for commutation riders is to provide liquidity at the death of a primary structured settlement annuitant. In some New York cases, commutation riders are mandatory. For example, when the structured settlement payments are being made to a supplemental needs trust. A structured settlement commutation rider does not have any upfront cost. The cost of the commutation is recovered by the annuity issuer if the annuitant dies during a period when there are remaining certain or guaranteed lump sum payments subject to commutation. Commutation riders do not apply to life contingent payments. When triggered, generally a commutation rider will provide a percentage of the present value of any guaranteed or certain remaining payments at the death of the annuitant. The percentage varies by structured settlement annuity issuer, but generally varies between 90 and 95%. The means for determination of present value that the commutation percentage applies to also varies by the structured settlement annuity issuer. It's something that should be scrutinized carefully, particularly when in conjunction with a special needs trust or supplemental needs trust. How do insurance companies determine the present value when a structured settlement commutation is triggered? One uses the purchase price of an annuity on the date of death of the original annuitant. That will provide the remaining payments to be commuted, and if those rates are not available, they usually have some other type of formula. Typically, a company may have, like there's companies that are out there that have discontinued a line of business, so that's when you would use the different formula. Two other companies use the term net cost of an annuity in its commutation where it has emerged in correspondence to an annuitant that net cost means the net of the structured settlement broker's commission when the structure was created. Several years ago, I fielded a call from a widow from Florida, the former client of another industry colleague, who was startled by this revelation after her husband died. When I conducted further research, including speaking to the annuity departments at structured settlement annuity issuers, it emerged that several are a bit less transparent. Some do not expressly use the term net annuity cost, but appear to apply the same or similar methodology. If the structured settlement commutation dial is set to 100% commutation and there's already enough money in the special needs trust to satisfy the Medicaid lien obligation at the death of the measuring life, then the periodic payments have been needlessly discounted. The spouse and/or heirs, as a result, might have been better off if the structured settlement is maintained, receiving income tax-free payments as scheduled. So how do you address this when the life can be so unpredictable? One company, Berkshire Hathaway, has a thoughtful solution that covers both contingencies. Number one, there are insufficient monies in the special needs trust to satisfy Medicaid liens. And two, there are sufficient monies in the special needs trust to satisfy Medicaid obligations and is available in 46 states that are members of the Interstate Insurance Compact. What is the potential downside of a net cost present value? Why could it be negative? In cases in New York City counties of Manhattan, Brooklyn, Bronx, Queens, and Staten Island, or anywhere that a structured settlement commutation rider is mandated where structured settlements pay into a supplemental needs trust or special needs trust, a net cost present value could result in less money commuted, and with a Medicaid lien payoff at death could result in less money or no money paid to beneficiaries. The most impact would be felt on a death within a few years of the structured settlement being created, where there are substantial numbers of guaranteed or certain payments remaining. All other things being equal in a minor's case or other case where payments have a deferred start date, a large number of guaranteed and or certain payments, where there's a large number of guaranteed or certain payments, the present value could rise each year until the first payment is made. If the annuitant is 4 years old when the structured settlement is established, and a lump sum at age 25 cost X dollars, at age 18 it might cost 2X dollars at the insurer's then current rates. So Berkshire Hathaway's thoughtful solution in solving the structured settlement commutation to special needs trust quandary is as follows. This is an excerpt from Berkshire Hathaway's commutation rider in such circumstances. The payments subject to commutation are defined as the pro rata portion subject to a maximum of 100% of each remaining certain payment as of the date of death of the measuring life that is necessary to satisfy but does not exceed the shortfall in the measuring life's trust. Upon the death of the measuring life, life contingent payments that have no value and are not included in the payments subject to commutation. Any remaining certain payments or portions thereof not subject to commutation will continue to be paid on the due date specified in the annuity contract. C, to determine if a shortfall exists, the trustee will determine the value of cash and assets easily convertible to cash, including the amount of any commutation payment from any other structured settlement provider, but not real estate or any vehicles as then held in the trust. From such value, the trustee will subtract the following: any taxes due the trust, estimated trust administrative costs and expenses, and the amount of outstanding Medicaid lien of every state that has provided Medicaid benefits to the measuring life. To the extent such medical assistance has not been reimbursed from another source and requires immediate lump sum reimbursement. If the calculation performed by the trustee as described above results in a negative number, such number is the amount of the shortfall. If a positive number, no shortfall exists. As soon as reasonably possible after the death of the measuring life, the trustee of the measuring life's trust communicates in writing to the annuity issuer, in this case Berkshire Hathaway Life Insurance Company of Nebraska, the amount of any shortfall, if any, calculated in accordance with the paragraph. The annuity issuer will conclusively rely on such communication. In the meantime, in my opinion, it would be sensible for other life insurance companies that issue structured settlement annuities in the primary market to consider adopting similar language in their own structured settlement commutation riders. So is there an alternative to structured settlement commutations? The structured settlement secondary market offers an alternative to commutation. Unfortunately, the lack of regulation of the structured settlement secondary market participants and the resulting mountain of documented bad business conduct from top to bottom has impugned the credibility of the structured settlement secondary market. If the structured settlement secondary market participants were licensed, regulated, and had a greater sense of legitimacy than they currently do, perhaps they could provide a viable alternative to liquidity the commutation rider provides, and perhaps at more favorable market-sensitive cost structure in certain circumstances. If you have any questions about commutation riders, feel free to contact me at the number below. My name is John Darrer. Thank you for watching and have a great day.